And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Thursday, second best day of the week, getting ready to wrap things up. Of course, yesterday was the big announcement we talked about yesterday morning. Inflation, if it's hot or if it's not, it was going to move the markets. If inflation was weaker than expected yesterday, that would send the markets higher. If it was hotter than expected, it would send the markets lower. Well, it came in hotter than expected. We'll talk a bit about CPI a little bit later this morning with Michael Leibowitz when he joins me, and also the impact on the markets in general yesterday. But we have more inflation data coming out, right? So now we've got to come up with PCE. We've got price inflation in terms of imports and exports. So lots of other measures coming along in terms of inflation. And again, as we've talked about before, the Fed does look at CPI, right? But their primary measure is trimmed mean PCE. So what's happening on that front? Again, if you take a look at the non-seasonally adjusted data yesterday in CPI, it was actually cooler, right? So the non-seasonally adjusted data actually went down. Once we throw in all the mathematical adjustments, we got the price increase in the inflation data yesterday. So again, there's a lot of things that are kind of jiggering and happening. There was a very, very sharp increase out of the blue, right? Actually, the trend of car insurance had been kind of trending down a little bit, and then out of the blue yesterday, there was a massive jump in car insurance. And those type of anomalies lend themselves more to adjustments rather than actual data. So again, just these are the things that you have to kind of consider as you look at this data. So again, are things more expensive? Absolutely. Groceries, car insurance is up, no doubt about that. But some of these kind of outlier events are the things you want to kind of pay attention to. And again, we'll talk some more about that this morning. But inflation kind of grabbed all the headlines yesterday. Pushed yields up on bonds, bond prices down yesterday, interest rates up because of the adjustment for inflation. Again, just kind of numerous impacts across the market from this, kind of this higher read of inflation, and the realization, right? And this is what I've kind of been saying here for a while. I've been having a hard time wrapping my head around this, which is why would the Fed cut rates when you still have inflationary pressures? Because if you cut rates, that creates demand, right? So what happens if we cut rates? We all go out and we buy stuff, right? Because the market goes up, interest rates come down, things get cheaper, so we go buy houses. That pushes house prices up. If you push house prices up, that increases the homeowners equivalent rent basis. So, cutting rates is exactly really not what the Fed should be doing if they're worried about inflationary pressures. Now, Mike will argue it's all about liquidity, but again, I think the Fed's caught in a very tough trap. But the thing I've been saying for a while is I don't really understand why the Fed would cut rates now, particularly with inflation kind of becoming a little bit more sticky here. Now, this kind of stickiness of inflation will eventually kind of go away, and we will get lower rates of inflation later on as the economy continues to slow down. A lot of that money comes out of the system that's still in there. That's inevitable. That will occur, but it's just going to take a lot longer to get there. And again, whether or not the Fed cuts rates is going to be up to them. But one thing the market priced in yesterday is probably no rate cut in June. So now all of a sudden we're pushing rate cuts out towards the end of this year. We may not see, and it's very likely that inflation is going to become a little bit more sticky here, at least for the time being, looking at these year-over-year comparisons and kind of where we are, that we may not get rate cuts realistically until next year. So again, this is going to be a market dynamic that's got to get factored in here a bit into markets, which have been kind of rallying on this expectation of that the Fed was going to cut rates, reduce their balance sheet, put liquidity back into the market sooner rather than later. It's now looking like it's going to be a little bit later. So here's what you need to know before the bell this morning. Yesterday, as we've talked about here over the last few days in particular, the market very much like we saw last year this time. So let's go back to last year as the markets were rallying, we had the AI chase that was going on. Everything was fantastic with AI. The world was fantastic. The Fed was going to cut rates. And the market was running right along the 20-day moving average and running right along this trend, this trend channel that the market was in. And then, we started talking about June, July. It took about 2 months, right? We were talking about the fact that, we were going to have a 5 to 10% correction. Well, we eventually got that, but importantly, what happened with the market is we began to see this market kind of make this kind of rounding top-ish, right? So that was that kind of depletion of momentum that was happening underneath the surface. And so as the market eventually kind of ran out of steam, then you had this correction that ultimately lasted all the way into October. So you had that 10% correction last summer. Well, this has been the same story now that we've been talking about for the last several months. We've had this very defined trend right along the 20-day moving average. It's been just doing exactly, every time we came down the 20-day, we rallied from it. It was easy. You bought the 20-day. But over the last few weeks, we've talked about this, we're now building that kind of rounded top once again in the market. So as this market continues, let me do a little bit better job of that. So as the market kind of continues to lose momentum here, we're starting to kind of build this rounded top in the markets. And then yesterday, we again, not only we took out the 20-day moving average, which has been the real support of that trend really ever since November, but we're now sitting on the lows from Thursday. So as we talked about previously, is like last Thursday, we broke that 20-day moving average and we said, okay, you don't do anything just yet. We broke the support line, but let's see what happens because this will help reduce that kind of whipsaw effect. The market got back above that 20-day moving average the very next day and stayed there for 3 days. And so it kind of looked a little bit in the short term like the market was going to be okay. But as we noted, we said that when we get to this point that we want to see a confirmation in the markets, we would see a break of the 20-day and we would take out that low from last Thursday. If the markets are, which right now the markets are slated open lower this morning, so we are theoretically this morning going to take out that low from Thursday. So we are now beginning to confirm this break of that trend line that goes all the way back to November and has been the key support for this market this whole run. So we are now getting that first piece of evidence that we are now taking out that support. Now, what will be important is not today. If we close lower than this 20-day moving average, so if we close lower than last Thursday's low today, that's fine. We need to see where the market closes tomorrow. If we have a huge rally on Friday for some reason and we get back up to the 20-day moving average, this is all going to negate. So again, we're putting all the pieces in place. We have a break of the 20-day, a retest of the 20-day that failed, and if we take out and confirm the break of these lows from last Thursday, we will now have a confirmed break of that trend. Then at that point, starting on Monday, we can begin to reduce allocation risk in portfolios. So again, we just got to kind of see what's going to happen over the next day or so, but this is where we're going to be very close. We're sitting very close to the 50-day moving average, which is going to be key initial support. So again, we could see the market come down today, bounce off the 50-day, rally back up, kind of start reversing some of this. We'll see. Markets are getting a little bit oversold here, not a lot, but oversold enough for a bit of a bounce. So again, we got to be a little bit cautious how we walk into this, but we are getting that indication that we have now kind of broken that bullish momentum that goes back to really the beginning of this rally in November. All right, that's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz and talk a little bit about yesterday's CPI report, what it means for the Fed and the markets kind of going forward. Don't go away. You're listening to The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Michael Leibowitz joining me to talk a little bit about CPI yesterday coming in a little bit hotter than expected. And again, it's not really surprising. We're just kind of in that phase right now economically that we're still kind of working through. And as we talked about last week, if you look at where economic growth is, where inflation is, where interest rates are, they're all about at equilibrium. They're about where they should be. Based on the long-term correlation between what's happening in the economy. So we still have some fairly robust economic growth. First quarter GDP growth is looking to be about 2.5% to 2.75%. We were at 4.9% in the third quarter of last year, over 3% last quarter. So again, fairly robust economic growth. It is slowing down though, right? So as we have less demand, less activity in the economy, that brings down inflationary pressure. So again, this is all kind of normalistic to a great degree. The disappointment to the markets and to everybody else is that it's not coming down faster because everybody wants the Fed to cut rates. So if inflation falls faster, that means the Fed can cut rates sooner. And this is kind of all thwarting the plans. The Fed's getting what they want. They wanted a stable, strong economy, right? We want stable prices and stable employment, which we've got. You've got very stable employment at this point. Unemployment remains very low. So the Fed's really kind of got nirvana, right? They've got a strongly growing economic environment. They've got interest rates up. And there's no sign of a recession. It's really about as good of a situation for the Fed as you could ask for, right? Because now they've got plenty of ammo in their gun. If there's ever a potential crisis in the future, another financial crisis, they can now cut rates, right? So again, do they cut rates now? They cut rates later. When do you use that ammo, so to speak, in your gun? And they have the ability to reduce their balance sheet right now. Markets are doing fantastic. The Fed's reducing their balance sheet. The markets don't care, right? So again, it's kind of a perfect situation for the Fed, and yet we're talking about, and the markets are now disappointed because they're not going to get rate cuts as soon as they had hoped. So, Mike, let's talk a little bit about the inflation report yesterday. Anything jump out at you in particular yesterday in the report?
I mean, you talked about it earlier, the auto insurance, and it certainly smells like adjustment. I've also heard that there were a lot of states that didn't allow insurance rates to rise in 22, 23. So some of that is catch up. And remember, auto insurance is a lagging indicator because they're adjusting their rates based on what it costs to fix cars and the price of new cars. So as those went up a while ago, right, they've actually come down. But when they went up, so you get the insurance that's catching up to the cost of auto repairs and new cars, which are more expensive than they used to be. So, you look at the number, auto insurance is an anomaly. Some of it's an adjustment, some of it is catch up, but it's not going to stick around rising 22% a year, or none of us are going to be driving cars.
Right.
And then you got housing, right? And we've talked about housing a lot. Housing is 40%, and it's rent. It's actual rents and implied rents, and that's 40% of the number, and that continues.
Real quick, can we stop there real quick and let's talk about that for just a moment, because homeowners equivalent rent is this kind of nebulous thing, right? It's not, it tracks part of what rents are, but there's also the question that gets asked to actual homeowners and saying, well, if you could rent your home right now, what do you think you could rent it for? And that gets imputed into, this analysis. So if I'm sitting in a house right now, housing prices are, and say in Houston right now as an example, housing prices are pretty stable. And so actually there's actually been price increases in homes in Houston. So all of a sudden homeowners are sitting on their house going, yeah, I'll rent my house, but you'd have to pay me, let's see, I'm paying right now $4,000 a month on my mortgage. So yeah, I'll rent it for $4,500, right? And so it's just kind of this, it's not really factual. It's just kind of a guess at what a homeowner thinks he could rent his house for.
Right. And if you were to actually impute it the way you were kind of going through it, here's the mortgage, here's my taxes, here's a little profit, here's the upkeep.
Yeah.
That would be based on home prices in theory.
Right.
And home prices have been flat for the last year, give or take a little.
Right.
Just like rents have been flat to actually declining. So, and look, this is a known, we can call it an issue, but the way CPI, the way the BLS calculates the data, they know there's a lag. They tell you there's a lag. And it's not a question of if, but when that huge component of inflation is going to fall. Now it could rise in the future because we are seeing a little uptick in house prices, but we know that based on what's already happened, that a large chunk of this is going to fall.
Right.
The other important thing to note about CPI is that it's not broad-based. Those are essentially the two items that are really driving above 2% inflation. If you go back about a year and a half ago, everything it was goods. Goods is actually sub 2% inflation now. That's a big deal. A lot of services are back to 2% or below inflation. So, it's not nearly as broad-based, and I think that's a big deal too, because we can look at those essentially two items, and auto insurance and housing, and it's much easier to predict those two than it is every item.
Right.
So, look, inflation's become sticky here. If they were to drop that housing number even by a few tenths of a percent, more, if it fell by a few tenths of a percent more than expected, we would have a surprise to the other side.
Right.
So it's just, and
that's probably gonna happen, right? We've had 4 months in a row of inflation outpacing estimates, and so just statistically speaking, you're probably about to run into a couple of months that is going to surprise to the downside.
Well, we know it's going to catch up.
Yeah.
So statistically, it'll catch up, and if you're conspiratorial, it'll catch up because it can lower inflation before the election.
Right. Yeah,
So
there has been that theory running around, is that there's going to be an adjustment to the downside, but it's you got to wait until about May, June before you start pushing that inflation number lower, because if you cut inflation too soon, then everybody kind of forgets about it going into the election. So if you really want to spark up voters, the conspiracy theory is we're going to start cutting inflation in June.
Right. Here's the other important thing. It's sticky. It's maybe rising a little, but we're sticky in the mid 3.5% range. Keep in mind where inflation was. I mean, it's crazy to think that we were at 7-8% inflation not that long ago, a year and a half ago.
Yep.
And, the pace has slowed. It stopped declining. Some people argue it's going right back up to 7%, but this environment is nothing like that environment. And we know that 40% of this number is coming down. So that 60% has to go up a lot for inflation to prove not sticky and actually rising.
Right. Well, and again, this is there's certainly catalysts that could change that dynamic. We did between the Fed and the government, we did about $11 trillion worth of stimulus into the economy in 2020, which is what created that inflation. There's still a lot of that money floating around, and again, this is one of the reasons why we haven't seen this, massive financial disaster that everybody was expecting, because there's so much money still floating around the system, but it is coming out, and economic growth is slowing. We are seeing the evidence of that in the data. NFIB reports yesterday, was just absolutely terrible about what's happening on the ground, kind of boots on the ground, small to mid-sized businesses. The environment is not good for them. So that's going to translate to slower economic growth. That's going to bring down demand. And again, inflation is simply a function of supply and demand. That's it. At the end of the day, it's too much demand for too little supply, or vice versa. And that supply side of the ledger is rising. If you look at home inventories, those are rising. Talking about rents, we've had a massive build in multifamily units over the last couple of years. And so there's an oversupply of multifamily units, which are going to put price pressures on rentals. I'm talking to people that own a bunch of rental properties right now, and they're still able to hold rents at the moment, but there's a lot of supply getting built, and they're not so sure they're going to be able to maintain those rent levels over the next couple of years.
Yeah, the multifamily supply hitting the market this year and next year, and a little bit less last year, is the most we've had in 40 years.
Yeah.
So there's a huge amount of supply coming online, this year and next year, which should, if anything, keep rental prices flat.
Right.
Maybe slight, depends on location, but it's hard to see how rental prices surge from here.
Yeah. So let's spin this back around to the big question, which is interest rates that popped up yesterday. Of course, we're about 4.5%-ish on the 10-year Treasury. Not really surprising, again, with that kind of inflation print yesterday, where economic growth is running right now. 4.5, 4.6, 4.7, kind of certainly well within line of where interest rates should be relative to where our current, economic growth and inflation is. But, again, kind of longer term, what are you kind of looking at in terms of interest rates and where we are in bonds?
Again, I think inflation is on its way down. I think the economy will slow. We can debate all day whether it's a recession or not, but I think it'll slow into the twos. And if we have inflation in the twos, bonds should be yielding in the low threes.
Yeah.
So, again, this isn't the 8-9% inflation. And at that time, yields were only in, comparatively, only in the lower 5%.
Right.
So we're not that far off from where we were when inflation was 5% higher. Think about that.
Yeah. All right, quick break. We'll come back, pick up a little bit on the market, because, again, with this kind of break in the market, let's talk a little bit about, kind of what may happen next and how to start kind of hedging for that potential risk. We'll talk about that with Michael Leibowitz when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season candid coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If you take a look at a lot of these videos that are getting put out on TikTok, it's like, working for the rest of my life, I'm just supposed to do this forever because I need money. The struggle is real for the new generation, which is now learning that 9 to 5 isn't as easy as going to college.
The Real Investment Show podcast. Same show, your schedule.
My daughter, she's 17, and she's discovered Kroger points for getting a discount on gas.
At realinvestmentadvice.com.
The struggle is real.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So let's take a trip around the markets here for a few minutes because there's a lot of things that are going on in the markets in general. And of course, we'll start with kind of the overall kind of S&P, which is obviously showing some signs of weakness here after 5 months of an advance that, we talked about last October, and we were talking about the reasons why we were going to have this rally was because of stock buybacks, extremely negative investor sentiment, extremely negative positioning. Everybody was kind of on the wrong side of the boat, and so that was the perfect setup for this rally. Now we've had this fantastic rally in the markets, which has done great. It's interesting right now is that a lot of people are talking about gold because gold prices over the last couple of weeks have had a very, very big move. So now all of the gold bugs have now popped up and said, gold's doing fantastic. We're now, and as is always the case, we're going to 3,000, we're going to 4,000 on the price of gold. It's always important that, these things can happen, right? You can have these moves in assets for various reasons, and a lot of it's narrative. And, what's important is how are you doing with your money overall, right? So, if you just look at where we are this year, gold's up, double digits this year. So it's doing great. Problem is if you would have just put that same amount of money in NVIDIA, you'd be up 150%, triple digits, right? Or, Constellation Energy Group's up 64%. They invest in nuclear energy. So it's always about where am I actually making money. It's great to have a narrative, right, and of whatever it is, and say, okay, this is my narrative, and I'm going to invest in this. And there's nothing wrong with that. You can have gold, you can have this, you can have that, you can have a little of everything. You don't have to be all of one or none of another. But it's always important to kind of remember that we're investing money, and so we want to try to make the most of our money as it goes forward. And so this is, kind of why we talk about risk management. We talk about these things are going on in the markets. And as I was explaining kind of, at the beginning of the show, we're now seeing that crack in the surface of equities, which has been driven by this whole narrative of the Fed's going to cut rates, going to, start doing QE again. And now that narrative is having to get pushed out. Again, another narrative, right, that we've got to push out because things aren't aligning in the way that the market's thought. So this now brings up some potential risk. And, this is where investors tend to make mistakes, which is going into these all or none type trades. And we see this all the time. So it's like, Lance said the market's cracking here, so I'm going to sell everything, go to cash, and I'll just wait it out. That never works out well, right? So, and as I've talked about this morning, you've got to wait for these confirmations to happen. You've got to wait to be sure that the market is changing its trend. And then you can reduce risk. You can short against the markets. You can do a whole variety of things. You can buy put options. You can do, write calls. You can do a whole variety of things to hedge your portfolio. But the question is just, taking your time. You don't have to do anything all at once. It's not about big moves, as we've talked about before here on the show. Managing money is like a game of football. It's about inches. If I can just keep moving the ball down the field an inch at a time, I'll eventually score, right? So I've just got to keep moving the ball, but I don't have to do it all. I don't have to throw a Hail Mary every single play, right? Because eventually I'm going to get intercepted, and that's just going to happen, and that's going to hurt. So again, we make small moves. We try to analyze each move and then make the best decisions. And again, not all assets are going to correct. We may see this market correct and stocks like Eli Lilly go up. I'm just picking a stock. I'm not saying it is. But I mean, we can see maybe the whole market corrects and maybe other assets still go up. Again, not, everything's going to go down at the same time. Not everything's going to go up at the same time. And in fact, that's when you should worry. When everything's going up at the same time, that's all a sign of about speculation and greed. So anyway, Mike, I'll shut up here for a second. The risk here is we may be seeing a loss of that momentum, and what are you looking at here?
Yeah, we're definitely losing momentum, and it feels like we've been losing momentum for a while. We're finally breaking through some key technical indicators, but we're in a bull market, and I think a lot of times we can get caught up in the very short-term graphs, which make every rally and every decline look monstrous. But sometimes it's important to just pull it back and look at where we've been over much longer time periods. It helps put everything into proper perspective and context. So, barring a recession, you have to assume we're in a bull market. In today's commentary, which you can get at realinvestmentadvice.com, sign up, get in your email every day. We show this bullish cycle compared to other bullish cycles. And just based on other cycles, we're only in the fourth, fifth, sixth inning. There's still room to run. This is still, from a performance and time perspective, a short bull market. Again, it can end, and that's why we're always paying attention to the narrative, to the technical, to the trends, to the momentum, to the fundamentals, what the economy's doing, what the Fed's doing. But at times like this where the markets get shaky, it's helpful to just pull it back a little bit and look at the longer term graph. And if you look at a longer term graph, you won't even see yesterday's move, or you can barely see that momentum is starting to fade a little bit.
Right. And I think that's really kind of key. We just went through a 20% correction in, 2022. We had this, huge rally in 2020, 2021. So in 2022, we had this 20% correction. So we're now coming back. We've just broken out to new highs. So just technically, if you just talk about a breakout to new highs, to your point, we're kind of in this kind of a new push higher because of that breakout to new highs. So again, coming back, retesting that previous breakout, that would be completely normal within a bullish market trend. So, again, there's nothing happening here that, we've gotten very far ahead of ourselves. Investors are extremely optimistic. Investors are extremely allocated to equity. So a correctional process of 5 to 10%, completely normal. And we should expect that. That's actually healthy for the markets. We'll kind of reset the market at that point. But, if you're betting on, hey, there's going to be a recession, in the third quarter and we're going to have a 50% decline, that's probably not the setup we've got in the markets right now.
Right. The markets aren't priced for that at all. They're priced, I think, for what you just said, a 5-10% correction, which if that's all it does and it rebounds, would actually be bullish, as funny as that sounds.
Right.
But, there's always the unknown. And this has always been the case with markets. Will we get into a recession? Could it be bad? What might it look like? Would the Fed be able to come to the rescue? A million different things. And that's just something you have to keep on the radar and think about. And when if the market's down 5 or 10%, pay close attention to the technicals. Just like we've been doing, the 20-day average has been the star. That's been the one to follow. And when we're down 5 or 10%, it may be the 20-day. It could be some other moving average. It could be some other technical indicator will help us. And usually a multitude of technical indicators can help us understand if we're bottoming out or if there's still more room to go.
Yeah. Well, and again, I think one of the key things too is, and you and I were actually having this conversation yesterday, Mike, is talking about credit spreads. And, if you just take a look at the markets themselves right now, yeah, the markets are correcting. We've had this huge run. But credit spreads are not warning of any real risk whatsoever at this point. So, if you take a look at the credit market, which is really based on fundamentals, and again, as we've talked about before, if I'm loaning money to somebody, I'm not looking at, oh, wow, Eli Lilly makes, a drug, right? Whatever. I don't really care about that narrative. I want to know, do they have enough cash to pay me back, right? Do they earn enough money to pay me back? Are they a good credit quality? What's my credit risk? What's my opportunity cost? All those type of things. And right now, there is no concern, really, that I can see anywhere in the markets about corporate risk.
Well, so that gets a little interesting because what they call the leveraged loan market, those are corporate loans. Mm-hmm. There are some signs of concern. There are higher delinquencies and credit spreads are not nearly as tight. But when you go to the corporate bond markets, that's where you got the really tight spreads. So there is a little concern in that market by the banks, the ones actually doing the due diligence. But corporate bonds, like stocks, also get the momentum. Mm-hmm. There's a lot of mutual funds, a lot of ETFs that buy them, and people just throw them into their portfolios for the extra yield, not really understanding what's going on. So, there are some signs, but again, if you look at spreads, they're not telling you that we're due for an imminent recession.
Yeah. Speaking of leveraged loans, it's an interesting point because, one thing that we've talked about previously was this big debt maturity wall that the Russell 2000 index has coming up. And if we take a look at the percentage of, I did this study here recently, our friends at Kailash Concepts, helped with the data. But you have about 30 to 40% of the Russell 2000 firms that are what's called zombie companies. In other words, their cash flow and revenue doesn't cover their interest expense. So they have to issue debt in order to basically stay in business. And interestingly enough, they've been doing that refinancing in the leveraged loan market because they can get better terms with less credit quality, right? So let's talk about that when we come back from the break because it does kind of an interesting setup of that debt maturity wall is hitting next year in earnest. And so it'll be interesting to see kind of what happens next. But small and mid caps, most susceptible to higher interest rates, most susceptible to small businesses downturn. We'll talk about them when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of things we get ready to wrap up the show this morning. Just talking a little bit about this leveraged loan market because it's very interesting because this is an ability for companies to take on debt that may be a much higher rate than if they'd gone through kind of a traditional corporate debt offering. And, Mike, we've talked about the, risk to small caps, particularly heading into next year because of this big refinancing wall that's coming up on those. And we're seeing a lot of these small and mid-cap companies, delve into this leveraged loan market to take on debt to kind of continue operations. Any risk there that you see?
Well, delinquencies are going up in that market pretty rapidly. So from the banking side, I think there's risks that the banks pull back and they either charge higher rates or they don't make loans. And like you said, these are zombies. If they don't eat, they go out of business. So, I think that's the risk. Or if rates just stay up here, a lot of these companies are borrowing to pay back old debt, pay back debt, along with operations. So if the interest rate is too high, and that rate may be too high right now, forget if it's even higher, these companies, again, could be in a lot of trouble, which it doesn't necessarily mean bankruptcy, but it does mean laying off employees, cutting other expenses, which have an economic effect. And Lance, you mentioned the Small Business Survey. It's bad. Small businesses, which are almost half of the economy, are in not good shape. So, I think we are seeing some problems with these smaller companies that don't have the bond market. They're just not big enough to access the bond market. You can't come to the bond market with a $25 or $50 million deal. It's too small.
Right.
So you have to rely on the banks and the leveraged loan market.
Well, that and also, too, these small and mid-sized companies in the Russell 2000, they don't have the war chest to go do, a couple of $1 billion worth of share buybacks to boost their stock price, right? So they're really dependent on the revenues they bring in and the amount of debt that they can actually finance. I mean, they have to run their business kind of as a real business. They don't have a lot of these other offsets they can deal with.
Right. And if their net income is starting to get hit because of interest expenses, that really weighs on those companies. And maybe that's part of the problem, what we're seeing in that survey, that higher interest rates are finally catching up with these companies, whether it's loans, bonds, or however else they fund themselves.
Mm-hmm. Yeah, no, that's right. And again, this is, I think a very important sector of the market. We've seen small caps, try to rally here with the markets as of late, but there's a tremendous amount of risk on that side. And there's a very long historical correlation between small business sentiment and the Russell 2000 index. So it's worth paying attention to what's going on with the NFIB. If you're investing in small cap stocks, it's worth paying attention to what the NFIB is saying, because there is a correlation between that data and what's happening, with these smaller companies. Go ahead.
I was just going to say, it just brings up a slightly bigger issue, that there are just an incredible number of inconsistencies in the economic data. The small business is one of them, that roughly half of the economy is telling you we're in a recession, yet the economy is doing just fine.
Right.
The manufacturing sector has been in a recession for 2 years. We're doing just fine. If you dig into the employment report, you see that full-time employment over last year has fallen by over 1 million jobs.
Mm-hmm.
That's typically, you're in the heart of a recession when that happens. And we could go on and on. There's just an enormous amount of data that just doesn't make sense with the headline data. And I'm not saying it's rigged. I'm just saying that the effects of COVID and all that stimulus and all the changes in our behavior have skewed the data so much. I think it's very hard to really appreciate how robust this recovery really is, how strong the economy is. And that leads to risks that what we think we see, we don't really see. And in time, reality catches up with the numbers.
Yeah.
So, that's a risk out there.
Yeah. It's interesting. I've got Newsmax reached out to me last Friday and asked me to write an article for them, and I'm going to publish it on our site tomorrow. But they wanted me to look at the impact of this illegal immigration that we've had over the last year or so on the actual employment numbers. And there's actually, it turns out there's actually a fairly high reason, or a fairly big reason why employment has appeared to me so much stronger than what you would think it would be because of the immigrations. And so, that article will be published on the website in the morning. But real quick, Mike has an article out as of yesterday on the website talking about gold. And this is something I had touched on, about a month or so ago, and got a lot of pushback on it. But Mike decided to pick up the gavel and run with it so he could hit himself in the head with it again. Anyway, so gold, is it running with the markets, or is it actually telling us something?
I'm a glutton for punishment. So, yeah, so I was looking at, what's driving the price of gold. And it's very easy to say that it's geopolitics, it's the deficit, it's inflation. You can go on and on with kind of what we would say are the fundamental drivers of gold when you don't have confidence in the government or the Federal Reserve. But when you really kind of focus in on those items like the deficit, and I'm not apologizing for the federal government, the deficits are way too big, but they're not really that far out of line with stuff we've seen over the last 20 years. The Fed is running the most hawkish policy we've seen in a long, long time. So as much as we may want to blame the Fed, they're the most hawkish, which is not good for gold.
And real quick on that, because we don't have a lot of time, I do want you to know one thing is real rates. And that's something that, the Fed does have control over to a degree.
Right. So in a prior article, which we linked to the article I published yesterday, we show that real rates, which is just the interest rate less inflation, has an incredible correlation with gold when real rates are low. When they're high, the correlation just falls apart. There is no correlation. So in those periods, whatever else is in the market is driving the market, be it geopolitics, fiscal, whatever supply, demand, technicals. But when real rates are low, that drives the price of gold. Low real rates imply that the Fed is being overly active, that they're manipulating interest rates too much. And we're just not there. They're not doing that. In fact, I think the reason they want to cut rates is because they think that they've left rates too high compared to inflation in the economy, which statistically is true. So, without the kind of steering wheel of real rates to drive the price of gold, I think it's left to the whims of the market. And if you look at the price of gold versus, we could say Bitcoin, but Bitcoin has some similar qualities as gold, but NVIDIA, the S&P 500, Eli Lilly, a pharmaceutical company, they all look very similar. It's not just look, their statistical correlations are very high. So I think that while, look, there are geopolitical problems, there are fiscal problems, there are problems out there. I don't think they've risen to the degree of dire as compared to where they've been over the last 20 years. I just honestly don't think they're that much worse. Not that they're good, and I don't, condone some of these things, but it's not that much different, which leads me to believe that gold is just getting swept up with a lot of other assets that have gone on moonshots, as the kids say.
Right. And again, there's nothing wrong with that. And again, absolutely nothing wrong with owning gold. If you own gold, I think it's fantastic. The important lesson here is always, and again, if you go back in history and look at previous spikes in gold, they're great. Just don't forget to sell and take some profits along the way, right? That's the whole thing that we continue to talk about. There is no asset that is not worth owning. At times. Now, there's times you don't want to own certain assets. You don't want to own certain assets right now, for sure, because they're not doing great. But there's other assets you do, and so just remember, it's always about making prudent bets. Because again, what's the whole goal of investing, right? It's not to try to prove out some theoretical thesis. It's to make money, and so we want to invest in these assets. We want to make money, but again, in order to make money, you've got to actually realize those gains at some point. So don't forget to sell and take some profits. That's it.
Yeah. And just one more along the topic. I got a great email last night saying, well, it's all about inflation, Mike. Don't you get it? Inflation is going to skyrocket again. I'm like, okay, it could be. But if gold is such a good predictor of inflation, why was gold flat to lower when
inflation was 9%?
No, before inflation was 9%, when fiscal spending was off the charts, when the Fed was doing everything it could, and the supply lines were getting shut down, when the recipe for inflation was sitting there right in front of gold holders. Why was it not moonshotting then?
Yeah. No, and that's the big debate. So again, it's just, again, nothing against gold, and if you own gold, fantastic. Just again, as with any asset, just don't forget to sell and take a profit. I'm sorry, Mike, go ahead.
And just understand, I do own some gold, and I understand why I own the gold, but don't get caught up in a rally that's just driven because of asset prices, not fundamentals.
I think the bigger lesson here, Mike, is be careful chasing the price of gold, right? Just
like anything.
Now, the price of gold has gone up. Everybody's now awake. It's like, oh, look at gold. I'm going to get in now. You may have missed that move to a big degree. It's extremely extended. So again, just all we're saying is it's your money. You do what you want with it. Just be cautious. That's it. All right. Wrap up the show for the day. That immigration article will be out tomorrow. Mike's full article on gold on the website now, realinvestmentadvice.com. Be sure and like and subscribe to the channel. We appreciate it. Appreciate you tuning in and watching every morning. We do pay attention to the chat, but y'all are just have your own conversation going on. So, if y'all ever want us to answer questions, you just, ask some questions and we'll do it. Anyway, have a great day. We'll see you tomorrow. Richard Rosso, John Penn for Financial Fitness Friday, and we'll see you back here on Monday.